yeah, that's exceptional revenue growth there. So we'll give that a big tick. Hey, I hope everyone's well out there. Today I'm taking a look at a Chinese company to do one of my high-level valuations. So I'll go through my 9-point checklist and then give you my opinion. And today we're doing JD.com. So I've invested in Alibaba, and I also have a pretty big stake in Tencent through a company called Naspers. JD.com is another one of those massive $100 billion plus companies. And yeah, we're gonna have a look at it today. So I hope you enjoy. All right, so JD.com competes pretty much head-to-head with Alibaba in the Chinese market. They're an e-commerce play. They sell stuff online, essentially. So they're a $120 billion market cap at the moment. And so Alibaba is more of a platform for buyers and sellers to reach a sale, and then the seller sends it to the buyer. It's closer to eBay than it is Amazon, whereas JD.com is closer to Amazon, that's how I would explain it. They're obviously it's not exactly the same as Amazon. It's very different in lots of ways, but they handle fulfillment just like Amazon, kind of the fulfillment centers in America handle fulfillment as well. So JD.com is kind of like that. Now, something I find really interesting about JD.com is they have a strategic partnership with Tencent and Walmart. So that's some pretty big, massive companies supporting JD.com's growth. And on top of all this is not just an e-commerce play in China. They also are spawning out new areas. For example, JD Health, where they're going to try to send medicine throughout China as well. So I think that's an interesting take, and it's a spawned idea coming from the initial e-commerce platform that they already have. Now, like I said, I'm doing a very high level approach here and just looking at some basic financial metrics here and going to give a bit of a valuation. Now, if the company was somewhere in the ballpark of my valuation, then I would go and do a really deep dive into the company and look at as much as possible to understand everything I could. Now, a really good way to understand how to do a deep dive into a company like this, well, I highly recommend going through Hamish HODDER'S course. Now, I don't want to make a course myself. I feel like there's a lot of better courses out there. And the one that I found that I think is the best of all of them is from Hamish HODDER. And he's another Australian YouTuber, and I highly recommend checking out some of his content as well to get more familiar. His course is fantastic. So he's kindly enough given us a discount code for viewers of my channel, just my friends and family essentially, if you want to get 30% off, you can use my discount code and you can get access to that course and go through all the examples that he puts together of how to do a deep dive. Now remember, I'm just going to do this briefly, and I highly recommend doing a deep dive, and I'll show you why when we get to the end. Now I'm going to put JD.com through my 9-point checklist and then give my opinion at the end. I do this with pretty much every company that I look at here on the channel. These are the criteria that I use to decide whether I should do a deep dive, and that's when I would go and use the Hamish HODDER approach that I just mentioned. I would understand then the in-depth stuff about the company, but I look at this stuff first, get an idea whether I'm interested or not, and then I go into that. So let's start with revenue growth, and we want to see revenue just growing, hopefully. So if I have a look here on the screen, over the last 10 years, it's gone from 21 billion to 855 billion. Wow, I think that's right in Chinese yuan. I'm pretty sure that's better than Alibaba. So yeah, that's exceptional revenue growth there. So we'll give that a big tick. So next up is gross margins, and we want to see big fat gross margins because if something goes wrong in the business, it means that they're hopefully not going to run at a loss. They've got a bit of room for error here. So if I look at the gross margins for JD.com, well, they're actually really low. So we're talking 13, 14%. It actually reminds me of Costco a lot here. I think that's about what the Costco gross margins are. So it doesn't necessarily mean this is a bad business, but it just means they're running tight margins, which I don't like to see. We're going to give them a cross, but it doesn't make them a bad business, which I'll explain a little later. Next up is return on invested capital, and that's essentially how good the management team are at using the money they create to reinvest back in the business, to grow the business, and hopefully that can continue. That's how compounding kind of works. So I look at this return on invested capital number, and as we can see, it's been negative all the way up until 2019, and it finally turned positive, and then it's become quite strong. We're talking like 20% kind of range here, which is fantastic. But look, all those negative years previous, and they've just turned like this into a positive number, doesn't give me much information really. I'll be honest, I really need to see this over at least a 5-year period of some sort of stability with these numbers so I can build up some conviction in this idea. So I have to give it a question mark. I'm not really sure. Okay, now next is debt. And debt is the number one reason why a company can get into trouble. If a company has no debt, it's pretty much impossible for them to go bankrupt. Well, it's very difficult for them to anyway. So what I do to check debt is I'm looking at their current assets compared to their current liabilities. That's going to help me work out if they're in any short-term trouble. So as you can see here, current assets are significantly bigger than current liabilities. And actually this current assets number of 285 billion, if I added up both their long-term liabilities and their short-term liabilities, their short-term assets cover both of them. So that means they're in a fantastically strong financial position. They're not in any trouble. So yeah, great, we can give them a tick. Next up is free cash flow. Free cash flow is essentially what's left over for us as the investors in the company. So I want to see this growing. And it should be growing in line with the revenue. So as we can see, it was sort of 5-10 years ago, the numbers were sort of sometimes negative, sometimes positive. Looks like 2018 was a negative year, but then it turned very strongly positive. We're talking 15 billion, then 30 billion. Looks like the trailing 12 months is going to be 25 or so billion. There's probably a bit of a pandemic related spike there in 2020. So look, free cash flow has been growing of late, and that's great. That's all we need to see. Now, the brokerage accounts that I use are Interactive Brokers and Saxo Bank. That's how I do my buying and selling and holding of my investments. If you want to take a look at Interactive Brokers, there's a link in the description which will, you can go and have a look at a demo account and just get a feel for whether you like how the platform looks and whether you think you can get it to work. The reason I like Interactive Brokers over all the other like free platforms like Robinhood and stuff like that is they've been around for a long time. They have a good management team. They give you access to the international markets. This is really important for me as an investor of the world. And I think the fees are really low. They're not Robinhood low, but they don't also have any hidden fees or hidden costs or anything like that as well. They're not going to hurt you on the spreads and things like that. So that's my brokerage of choice. Next up is shares outstanding. This is really important because this number is getting bigger. It means that we're actually getting diluted, and that means our return on our investment is getting worse over time. So we want to see this at least stable, hopefully declining if possible. And if I have a look at the shares outstanding, it was sort of 1,400, 1,200, and now it's about 1,600. So, sorry, that's 1.6 billion. Let me say that again, 1.6 billion now. It was 1.4 billion or so. So it has been increasing. That's a problem. So we have to give that a cross. Now we turn to insider ownership, and we want the management team aligned with us as shareholders. So to check that, I'm here in Simply Wall Street. The biggest owner of JD.com is actually Tencent, which I mentioned earlier. And then the founder, Qingdong Lu, at about 15%. So he's still on the board of directors. He's still part of the management team. He has a massive stake in the company, and his net wealth is tied to how JD.com performs. So that's great. We can give that a tick. Now we go look and see if any super investors have invested in this company, because look, I'm not that smart, and look, I'm probably going to miss something because I don't have that much experience, and look, it stops me being an idiot. Therefore, I would have more conviction if there were some really smart people invested in this company as well. So to check that, I go to Data Roma and I just type in the ticker, and it tells me that, well, some of the people that I'm familiar with, Greg Alexander, Daniel Loeb, Bill Miller, they've invested in this company. Therefore, it has gone through their filters. That's all I need to see. We can give that a tick now too. Now, last but certainly not least is the price. Now, price is the most important thing. See, great companies can get seriously overpriced and you get really bad returns. So for example, back in 2000, you could have put Microsoft at, I don't know, $60, $70. I can't remember what the price was back in 2000, but it took 17 years to get back above the price that you would have paid in 2000. It's a fantastic company, Microsoft, but it doesn't mean you should overpay, because you can just get terrible returns over multi-decade periods. So we want to make sure the price is under fair value, so we're getting some margin of safety as well. And to check that, I use my intrinsic value calculator. So I've already gone through and filled in a lot of this information already. Now, the growth rates were a little bit tricky. What I've done is in Simply Wall Street, I can actually have a look at what the analysts recommend. And as you can see, the analysts' future forecast for the revenue is 17% and the earnings is nearly 30%. That's what they're thinking it's going to be moving forward, well, for the next 12 months anyway. So look, that's pretty extreme. I'm gonna call it, let's not be too conservative. Let's be about somewhere in the middle of those numbers and call it 25% for the next 5 years. And then look, it's a massive company. It can't grow at 25% for 10 years. I can't imagine anyway. So let's slow that down to 15%. I'll use a big discount rate. Now the reason it's so big is because I want to get somewhere in the 20% return on my money. But if I aim for 30%, well, it's sort of like aim for the stars, you might hit the moon kind of idea. It also builds in a pretty big margin of safety. So I'll tinker around with that in a moment as well. Because of those growth rates, the multiple of free cash flow is probably going to be about 20 in 10 years time if those growth rates are right. Then I just put in the free cash flow and shares outstanding, their cash and their debt. It tells me I want to buy this company at around about $35. And if I go have a look at the price at the moment, it's $78 right now. So it would need to pretty much get cut in half for me to be really interested in this company. But remember, those growth rates are pretty aggressive. Let's call it the same as their revenue growth. So let's call it 17% and then 15%. It means I want to buy this at about $30 a share. But then again, my discount rate is really big. Maybe I can be not so crazy about that and go say 15%. Maybe I only want 10% return on my money. It would tell me I want to buy this at about $60. That's including a pretty small margin of safety, aiming for about 10% return on my money. That's not really what I want. The market's probably going to do 5 to 10%. So I kind of want to, if I'm going to risk investing in China, I kind of want a big return. So I really want to go for something like at least 25%. And we're still talking that in the 30s anyway, somewhere in there. So my opinion of JD.com is that, look, it's growing really strong. And I like e-commerce in China in general. Gross margins are pretty slim though. But like Costco and Amazon, this could be one of those scaled economy shared kind of businesses that Nick Sleep would explain, whereas their prices are low and their margins are low because they're passing all that savings back onto the customer. And because they're doing that, they're building up this long-term reputation of being the best priced e-commerce play in China, and that will serve their customers for the long term, keeping them coming back to JD.com. That's probably what they're going for here. Therefore, their gross margins being tight, I can see what they're trying to do here. I think they're trying to do something like Costco and Amazon, and that's pretty smart because Costco and Amazon are unbelievable companies. Now, a problem I did find, not just the price, was that the shares outstanding number was getting bigger, which I really didn't like to see. They do have really strong partners with Tencent and Walmart, so that's another positive. But if I compare it to Alibaba are cheaper, like the price at the moment is significantly cheaper to their value. And I think Alibaba have better financials because their gross margins are significantly bigger. Now, from a personal point of view, I've actually invested in Naspers, which owns Tencent, which indirectly owns JD.com. So I kind of have exposure to JD.com already. Therefore, I don't need to chase this one. I'm happy that I've already got a little bit of exposure there, and I wouldn't be buying it at this price anyway. So yeah, that's my opinion. That's JD.com for you. I hope you enjoyed this video, and I'll see you next time.